When we think about the 2008 financial crisis, a few things probably pop into your head, right? Subprime mortgages, crazy derivatives, banks taking huge risks. We think we know the story. But what if a huge piece of the puzzle wasn't buried in some complex Wall Street algorithm, but in the very design of the American mortgage itself? A design that, believe it or not, looks a whole lot like a really risky, poorly run company.
So let's kick this off with a question that might sound a little weird at first. What on earth does a sketchy, underfunded corporation have in common with the housing crisis? Well, as we're about to see, the answer is pretty much everything. And it points to a massive flaw in the system that made the 2008 crash feel almost inevitable. All right, so to really get this, we first need to look at the perfect financial storm that was brewing inside the mortgage market. It wasn't just one single thing. It was this combination of two kind of normal-seeming features that together created a uniquely dangerous situation. Yep, just two policies. And on the surface, they looked like they were designed to help people buy homes. But in reality, they created a system where all the risk was completely out of whack. Let's break down the first one.
First up is this idea of riskless borrowing. Now, this comes from a specific type of loan that's super common here in the US, but actually pretty rare everywhere else. And it allowed homeowners to make a cold, hard financial calculation that had, well, devastating results for the whole economy. So here's the key difference you've got to understand. See, in most countries, if you get a mortgage, it's a recourse loan. That means if you stop paying and the bank sells your house for less than you owe, they can come after your other stuff, your income, your savings, you name it. But in a lot of US states, including foreclosure hotspots like California and Arizona, mortgages are non-recourse. The lender can only take the house back. That's it. Your other personal assets are totally safe.
And that leads to this huge consequence. With a non-recourse loan, if the value of your house just tanks and you're suddenly underwater, meaning you owe way more than the house is worth, it can actually become a smart financial decision to just stop paying. This is called a strategic default. You can literally mail the keys back to the bank and just walk away. Sure, your credit score gets hammered, but your personal savings are untouched.
Okay, so that's ingredient number one, loans that let you walk away with pretty limited personal damage. Now, let's add the second, truly explosive ingredient to the mix, the almost complete disappearance of the down payment. This meant that tons of borrowers had absolutely no skin in the game. Just look at this number for a second, 100%. From 2005 to 2007, right at the peak of the bubble, the median loan-to-value for a subprime mortgage was 100%. And remember what median means? It means half of all these borrowers put $0 down, nothing. They had no equity cushion, no initial investment to lose, not a single penny.
So you put those two things together, the walkaway loans and the zero down payments, and you create what economists call a massive moral hazard. Borrowers had every reason in the world to take out huge loans for houses they couldn't afford at crazy inflated prices. And why not? If prices kept going up, they won big. If prices crashed, they could just walk away, having lost absolutely none of their own money. It was basically a risk-free bet that poured gasoline all over the housing fire.
Okay, now here's where it gets really interesting. To truly get how dangerous the setup was, we have to look at a field that seems totally unrelated, corporate law. Because it turns out there's a classic problem in the corporate world that perfectly mirrors what was happening in the housing market. The concept is called corporate undercapitalization. Now, it sounds complicated, but it's really simple. It's just when the owners of a company don't put enough of their own money, their own equity, into the business to cover the risks it's taking. They're basically running the company using other people's money. And shareholders have a couple of clever ways to do this. The first one is obvious, right? They just don't put much of their own cash in as equity. But the second one is a bit more sneaky. They'll put money in, but they'll structure it as a loan to their own company. That way, if the business goes bust, they get to stand in line with all the other creditors to get paid back, instead of being last in line where shareholders are supposed to be. Either way, the goal is the same, minimize their own personal risk. And this quote really nails the problem. Undercapitalization creates a setup where the owners can take these huge, wild risks to chase massive profits, because they know that if it all goes wrong, it's the creditors, the people who lent the company money, who are going to take the hit. All the risk gets pushed onto someone else. So, this is it. This is the big aha moment. What happens when we take this corporate idea and lay it right over the housing market? Well, all of a sudden, the subprime home buyer
starts to look a lot like a risky gambling CEO. I mean, look at this. The parallel is just shocking. A homeowner putting no money down, that's the exact same thing as a shareholder having no skin in the game equity. That non-recourse loan that lets you just walk away, that's basically the homeowner's version of the shareholder's limited liability protection. And strategically defaulting on the house, that is the exact same concept as a company externalizing risk onto its creditors. And in our story, the creditors, well, that's the lenders, and ultimately, the entire financial system.
So what this all means is that the borrower with no money down and a walkaway loan was given the exact same set of incentives as a shareholder in a risky, underfunded company. They get to capture all of the reward if the house goes up in value, while the risk, the downside, was almost entirely pushed onto somebody else. The parallel isn't just close, it's perfect.
So if the problems are the same, well, maybe the solutions are too. Corporate law has been developing ways to deal with undercapitalization for decades. So what if we just took a page from that playbook and applied the same logic to the mortgage market? Okay, the first proposal is what you'd call an ex-ante solution. It sounds like a fancy legal term, but it just means it's a rule you apply at the very beginning before a loan is ever made. The idea is actually pretty simple, but it's really powerful. If you want the benefit of a non-recourse walkaway loan, you have to put some money down. It doesn't have to be the old school 20%, but it has to be a meaningful amount. This forces the borrower to have real skin in the game. It creates that vital equity cushion to absorb price drops, and it makes them think twice before overpaying or just walking away. They finally have something to lose. All right. The second proposal is an ex-post solution. So this is one that kicks in after a zero money down loan has already been made and things have started to go wrong. This one's a little more nuanced. It says that if a borrower put absolutely nothing down, then their non-recourse protection isn't total. Instead, if they default, they'd be on the hook personally, but only for a small, limited chunk of the debt. The loan basically becomes a hybrid, partly walk away, partly not. This stops people from strategically defaulting for no reason, but it also protects them from being completely wiped out financially. When you get right down to it, the goal of both of these ideas is to fix that broken incentive structure. They just try to rebalance the risk so that everybody, the borrower and the lender, has a shared interest in things working out. It's not about punishing anyone, it's about building a smarter, more stable system for everyone.
And all of this leaves us with one last big question to think about. The push to make home ownership easier and easier led to a system where a lot of people had absolutely nothing to lose. But maybe, just maybe, the American dream is actually safer and a whole lot stronger when everyone involved has some real skin in the game.